Iran's Revolutionary Guard hit 2 tankers under US military escort. Crude jumped past $90 a barrel. Trump's cabinet is now in crisis talks at Camp David over the strikes. By the end of this video, you'll know the one currency pair most exposed to this crisis and how traders are thinking about playing it. This isn't just an oil story. It's now feeding straight into rate expectations and safe haven flows across every major currency. The Canadian dollar typically gains against a weaker dollar in risk-off phases thanks to its crude correlation. But if the dollar itself becomes the safe haven trade, that CAD support can vanish fast. The yen usually strengthens on geopolitical stress as Japanese capital comes home. But Japan imports almost all its energy, so a prolonged Hormuz closure hurts its trade balance too. That tug of war makes USD JPY one of the hardest pairs to call right now. Europe imports huge volumes of Gulf energy, so any disruption widens its trade deficit and weakens the euro. Norway and Russia, both energy exporters, could see counterintuitive currency strength, though sanctions complicate ruble trades. Oil shocks move currencies through 3 channels: terms of trade, inflation expectations, and risk appetite. With roughly a fifth of global oil passing through Hormuz, this isn't a marginal disruption, it's a dual supply and policy shock. The Fed now faces a genuine dilemma. Energy inflation argues for holding rates higher. Weak consumer spending argues for cuts. Stick around, the currency to watch and the actionable setup are just ahead. Energy majors like Exxon and Chevron are posting outsized profits, indirectly supporting their home currency through repatriated earnings. Eurozone, Japan, and emerging Asia face the steepest currency headwinds as energy importers. The biggest risk to any of this is sudden de-escalation. A Camp David ceasefire could unwind these moves in hours. With only 1 in 3 Americans backing the war, political pressure for a quick resolution is rising fast. The pair most exposed here is USD JPY, caught between safe haven demand and Japan's energy import shock. The play many traders are weighing: modest energy currency exposure paired with defensive yen positioning as insurance. Just remember, oil correlations often break down entirely once markets hit full risk-off panic. Size accordingly. Read the full analysis on edge-forex.com. Link is in the description.